Bismillahirrahmanirrahim. Assalamu alaikum everyone. My name is Yasir Yameen and I welcome you all in this financial reporting session. My friends, in today's session, we'll be discussing one area of financial reporting, which is, I think it's very important for you guys when you go into your examination. Now, this has also been discussed by your examiner in a particular technical article, and that is why I think this is something which should be tested in the upcoming attempt. And you know what your examiner might try to test you? Your examiner might try to test you IFRS 5. Now, IFRS 5, you must have studied that IFRS 5 has two aspects. One is non-current assets, being held for sale. And there is another aspect to IFRS 5, which is discontinued operations. Now, this particular article that I'm referring to particularly talks about discontinued operations. Now, you need to remember that whenever we are discussing about discontinued operations, we are talking about a separate component of an entity which is being discontinued. Yeah. Or it's a subsidiary which has been acquired with an exclusive view to resale. So it may be, a separate geographical location or area of operations, right? So whenever there is a discontinued operation in place, you always remember that it will call for a separate disclosure form. It will always call for a separate disclosure and presentation form. Yeah. And what do I mean by that? So now let's discuss what do I mean by different presentation form. So for example, examiner can provide you a scenario and which, a similar type of scenario we are going to discuss, just as we move ahead in this class. So for example, there is a parent company, right, who has two subsidiaries. Let's say subsidiary number 1 and let's say subsidiary number 2. Now, this subsidiary number 2, which represents a separate geographical area of operation, is being discontinued or is being disposed of during the year. Now, remember when we studied about, disposal of a subsidiary, we studied that once you dispose of your subsidiary, you will have to calculate profit or loss on disposal. Balance sheets will not be consolidated for this subsidiary. Balance sheets will not be consolidated for this subsidiary because as at the balance sheet date, there is no control. But I told you that the P&L would be consolidated. P&L will be consolidated. P&L will be consolidated for the pre-disposal period. For the pre-disposal period. Yeah. So I remember I told you that while we were discussing the disposal of a subsidiary scenario. But you need to assess that when this subsidiary number 2 represents a discontinued operation, this particular mechanism which we just discussed will not be followed. What I'm trying to say is, although during consolidation we studied that for the sake of profit or loss account, if we, for example, if we lost the control of subsidiary number 2 9 months after the start of the year, at least we have to consolidate this subsidiary for the pre-disposal period, all agreed. But if that subsidiary represents a discontinued operation, and you need to know what a discontinued operation is, it should represent a geographical area of operation or separate line of business. So for example, if you are disposing of a subsidiary which represents a separate line of business and it's a discontinued operation, you cannot simply consolidate that subsidiary during the pre-disposal period. Rather, the presentation would change. Let's say this is your P&L. Let's say there is your P&L. You need to bifurcate your P&L into two headings. First of all, you'll be putting up a heading of continuing operations. Yeah. And then in the heading of continuing operations, you will be consolidating and preparing your group accounts. You'll be taking your revenue, your cost of sales, your gross profit, your other expenses, and your, PBTs and PATs, whatever. But here you will only be consolidating two entities. That is parent company plus S1. And then if subsidiary number 2 falls within the definition of discontinued operation, you will be making another heading for discontinued operations. And here you will be showing the post tax, the post tax profit or loss on discontinued operation as a single line item. This will be shown as a single line item. So technically speaking, subsidiary number 2, if it represents a discontinued operation, remember, if it does not represent a discontinued operation, if it does not fall within the scope of IFRS 5, then no such headings are required. Then you consolidate that particular subsidiary for the pre-disposal period. For example, it can be 6 months, 8 months of consolidation, whatever. But if it represents a discontinued operation, you cannot consolidate S2 as part of continuing operation. That won't be allowed. Rather, you will be showing S2 not as a consolidation of the group, but you will be showing the post-tax profit or loss of discontinued operation as a separate line item in your P&L. And the working of this post-tax profit or loss can be shown within the disclosures of the financial statements being published. Make sense? So what I'm trying to teach you is that if in the case of consolidation, your examiner provides you a subsidiary which is being disposed of during the year and it represents a discontinued operation, the formatting of your consolidated P&L changes. The formatting of your consolidated P&L changes. Sir, how will this work out? Can you please illustrate this? In fact, your examiner has given you an article on IFRS 5 discontinued operations, and here and there your examiner has actually discussed through an illustrative question how discontinued operations question should be solved. And I'm going to do that in front of you guys. I'm going to solve the same question which has been given by your examiner in the technical article, and I'm very sure this will help you. Please listen to the lecture very carefully because this might be tested in your upcoming examination. So your examiner says, for example, there is a question. The individual statements of profit or loss for 2Z company and its subsidiaries for the year ended 31st December 20x3 are given as follows. So first you need to understand that there is one 2Z company and this is your parent company. And then there are two further subsidiaries which have been presented in front of you, Lao company and Neo company. So Lao company is, for example, your subsidiary number 1, and for example, New company is your subsidiary number 2. And the accounting year end that we are discussing here is 31st of December 20x3. So 3 individual profit or loss statements are present in front of you. All right. Now, these are very crystal clear and simple profit or loss statements, nothing technical here. You have been given revenues of the parent company and its 2 subsidiaries, cost of sales respectively, gross profits respectively. Then you have been provided with some administrative expenses of each of the 3 companies. You also see that there is a specific line item of investment income of 300,000, and this investment income of 300,000 is only present within the individual financial statements, individual P&L of your parent company. So we need to take care of this. We need to identify, what exactly this investment income relates to. Because there can be a circumstance where this investment income relates to, for example, any dividend which has been provided by the subsidiary. In that case, it would be exposed to elimination of like items, and therefore this investment incomes might get cancelled off. So again, what I'm trying to say is you need to focus on what this investment income actually is while we read the notes. Then moving on, you have been provided with income tax expenses and profit after taxes and so on and so forth. Now, there are some adjustments that have been provided to us, and towards the end of these adjustments, we are responsible to prepare group consolidated statement of profit or loss for the year is ending 31st of December 20x3, right? So let's start studying. Examiner says, note number 1, for years, many years, 2Z company has wholly owned Lao company. So first of all, you need to understand that Lao company is 100% owned by us. So there is no NCI as far as Lao company is concerned, and owned 80% of the shares of Neo company. So 80% holding in S2, and that does mean that NCI is 20%, right? So NCI is 20%. Remember that. Then your examiner says neither Lao or Neo company paid a dividend during the year, and there were no intragroup transfer of assets. So there were no intragroup transactions that are in question, luckily. This is a very basic question that your examiner has discussed in a technical article. So you are better able to understand what's the core concept deliverable of this question. Yeah, no intragroup transactions. Let's move on to note number 3. Examiner says 2Z company, and remember 2Z company is the parent company. Yeah. So examiner says 2Z company acquired its shareholding in Neo company. Neo company is subsidiary number 2, by the way. So 2Z company acquired its shareholding in Neo company on 1st January X1. We are standing on 31st December 20X3, and your examiner is talking about 1st January X1. That is approximately 3 years before the year end. So Toze company acquired its shareholding in Neo company on 1st January X1 for a cash consideration of $200 million. So when we were acquiring the other entity, we paid $200 million, right? On 1st July X3, 1st July X3, that means, approximately 2 years and 6 months after the acquisition. 2 years, 6 months after the acquisition your examiner is talking about. On 1st July 20X3, 2Z company disposed of its entire shareholding. Note this, entire shareholding in Neo company for a cash consideration of 300 million. So this was basically the buying proceed, and this 300 million is basically the disposal proceed, right? And examiner says the proceeds received have been included in the investment income of Tozy company. So this entire 300,000, if you remember, we were discussing this 300,000 earlier. This entire 300,000 basically relates to the disposal proceeds. Now these have been shown, the entire disposal proceeds have been shown as a profit of parent company, while that might not be true. You always need to calculate gain or loss on disposal. The entire sales proceed never becomes your income. So technically this is incorrect even for the individual financial statements, right? Moving on. The proceeds have been received have been included in the investment income of 2Z company. Wow. Examiner says the disposal qualifies as a discontinued operation. So as far as Neo is concerned, there are some things that you need to keep in mind. First of all, Neo was disposed of. It was disposed of on 1st July X3. And if it was disposed of on 1st July X3, then this means only 6 months of consolidation can be done, or 6 months of working can be done. So everything that you see here should be 6 by 12, first of all. Make sense? Done. And the other thing is that it qualifies as a discontinued operation. And since this qualifies as a discontinued operation, we do not need to consolidate Neo company simply within the parent company for 6 months. Rather, we need to provide it as a separate heading as discontinued operation. And in that heading, we'll be showing post-tax profit or loss for the year on account of Neo company. Yeah. So you need to make sure that you cannot consolidate S2 here. Rather, you will be showing it as a discontinued operation separately, because this is one type of income that will not follow in the upcoming years. So your shareholders should be specifically told about that this profit or loss relates to the Neo company, which is not going to be there next year. They need proper disclosure. Yeah. So, all right. So two things we need to account for, one the buying and the other one is disposal. So examiner basically says at acquisition, and at 31st December 20x3, new company's equity share capital was $30 million. So both, even at the acquisition date and the disposal date, the share capital was 30 million. Examiner says new company's retained earnings at those dates were 130 million and 203 million respectively. And by the way, you need to take this into account. I meant to say that at acquisition and at 31st December X3, not at the disposal date, but at 31st December X3, share capital was 30 million and retained earnings were this. Now, what I mean to say, let me just explain you. And you need to carefully listen to what I'm saying. I'll do this here. Consider it working number one. You see, if I prepare a timeline for you, I write 1st January X1, which is the acquisition date. At this date, examiner says your share capital was 30 million, right? And at this date, at acquisition, your retained earnings were 130 million. So we know what were our net assets at the acquisition date, right? Then you see, then the examiner talks about 31st December 20x3. Now, while you reach 31st December 20x3, there have been 3 accounting year ends. So the first accounting year end would have been on 31st December x1, then on 31st December x2, and then there comes 31st December x3. 31st December x3 is the year end. And at this date, your examiner says your share capital is still 30 million, but your retained earnings at this date, are basically 203 million. Now, I would like to make up a point in front of you. You see, if you really understand, this 203 million of retained earning is of no use for me. You know why? Because guys, we eventually disposed of the entity 6 months down the road on, on 1st July or 30th June X3. So technically speaking, I don't need the share capital or retained earning or net assets of this date. Rather, I want the net assets on the disposal date because I'll have to calculate gain or loss on disposal. Now, as a matter of fact, I know the share capital would have remained same. It was same at the acquisition date. It is same even after 3 years. So obviously, even 2.5 years after, it would have been the same. The share capital would have been the same. But sir, the question is, what about retained earnings? Now, I need retained earnings balance at 1st July X3, which is the disposal date. Now, how do I calculate retained earnings at this date? To be honest, it's very easy. It's very easy. You see, you have been provided with complete profit or loss for the year. Do you agree? You have been provided with complete profit or loss for the year. And you see that new company earned 57,200 during the entire year. So new company in the entire year earned PAT of 57,200. And if you see this closely, examiner says the results of new company accrued evenly throughout the year. So basically you earned 57,200 in the entire year. And if you divide it by half, let me just pick up the calculator. 57,200 divided by 2. This means technically, if it accrued evenly throughout the year, 28,600 would have been earned in the first 6 months and 28,600 would have been earned in the last 6 months. So technically, if you work back retained earnings to 6 months back, it can be calculated as, that can be calculated as 203,000, which is 203 million, minus the 6 months earnings that they would have earned after the disposal, which is 28,600. So technically speaking, the retained earnings at this date would have been 174,400. A share capital of 30,000, to be very specific, if we talk about it in thousands. Yeah. Remember, this is millions and this is thousand, just to be very specific. So share capital would have still have been 30,000 or 30 million. And your retained earnings, if you work it out, if you subtract the last 6 months of earnings, you would get reverse working, you will get 174,400. Now, these disposal date net assets are important for me. Why? Because I'll have to calculate gain or loss on disposal, and there I need net assets at the disposal date. So, okay, now I have realized that I have solved note number 4 as well. Examiner says 2Z company measures non-controlling interest at acquisition at fair value. That is full goodwill method. On 1st January X1, the fair value of the non-controlling interest on 1st January X1, by the way, means the acquisition date. On the acquisition date, the fair value of NCI was 46 million. An examiner goes on to say that the carrying amount of new company's net assets in the individual financial statements at the date of acquisition were equal to their carrying value. So technically, there were no fair value adjustments that were required at the date of acquisition. And the last note that is relevant to us is the goodwill related to new company had been impaired by 2 million in the year ended 31st December X2, which is the last year. But no further impairments have occurred. There has been no impairment in the goodwill of Lao company as well. So now I have read the whole question. Having read the whole question, I'm well aware that I will have to calculate profit or loss on disposal, and then only I can make the consolidated P&L in the required format. Now, I will take you through some steps. Just follow me. You see, the first thing that you need to do is to work out the gain or loss on disposal. Yeah. Ultimately, I mean, you have disposed of a certain entity. And if you have disposed of your shareholding in a certain entity, you need to calculate gain or loss on disposal. And what was the format of calculating gain or loss on disposal? The format was like this. You had to take disposal proceeds of selling a particular entity. Then you had to take net assets of S company at disposal date. And when you talk about net assets at the disposal date, first of all, you need individual company net assets. Yeah. Obviously, that will include the share capital plus retained earnings that we just worked out at the disposal date. But these are individual net assets that you are taking. So you need to couple it with the consolidated net asset adjustments. So you add goodwill here. Goodwill in new. Yeah. For that sake, you would also need to calculate goodwill, by the way. We will just be calculating goodwill as we move forward. And as you pass through, you will need to subtract any NCI that is available at the disposal date. So technically speaking, you also need to work out NCI. Yeah. So before I even move on and go and calculate the gain or loss on disposal, now I know that I need goodwill first. So let's do a particular working to calculate goodwill, the calculation of goodwill. Yeah. And it's not difficult, I tell you. First of all, you take parent company's investment. And since I know that the examiner was valuing NCI at fair value, that means it follows full goodwill method. Then I would need to add fair value of NCI at the date of acquisition. Once I'm done with this, I will be subtracting fair value of net assets of S company. And I know it for sure that, first of all, there were no fair value adjustments. And fair value of net assets of S company are supposed to be taken because the excess consideration paid over the net assets of the other entity, basically that is goodwill. So first of all, you take parent company's investment. Parent company's investment was, you see, we paid $200 million to buy 80% of Neo company. So this is 200,000. Then we had to take fair value of NCI, and if I remember it correctly, that was 46 million. So 46,000 if you work it out in thousands. Yeah. Then I take net assets of S company at the date of acquisition, and if we look at it closely, these were the net assets at the date of acquisition, 30,000 and 130,000. Yeah, talking about it in thousands, that would be, I guess, 160,000 if I'm not wrong. Yeah, 130 plus 30 is 160. And then if you work it out, this will be 246 minus 160. And I guess this should provide you a goodwill before impairment of 86,000. And then you subtract any impairment that happened. And that impairment was basically 2,000. And here you go. You are left with goodwill after impairment of 84,000. So at the very least, I've got some data to work out. Now, if you go back to the gain or loss on disposal working, first of all, you take disposal proceeds. As far as I remember, these disposal proceeds were 300,000 or 300 million, as the examiner said. Yeah, this disposal proceeds. Yeah. Then you take net assets of S company at the disposal date, and I figured out that these net assets were 174,400 plus 30,000. Let me add these up. 174,400 plus 30,000. This is going to be a total of 204,400. Yeah. Adding up goodwill, I have a goodwill of 84,000 now. And now, before I conclude on my working of gain or loss on disposal, I need NCI as well. So let's work out NCI now. Yeah. NCI. And you guys know how to work out NCI, right? So the formula was fair value of NCI at the date of acquisition, fair value of NCI at the date of acquisition, plus post tax share of profit or loss, whatever. So starting with fair value of NCI at the date of acquisition, as a matter of fact, I already know that was 46,000. How do you calculate share of profit? The share of profit would be, you see, at the disposal date, our retained earning at the disposal date, our retained earning was worth 174,400. And at the date of acquisition, our retained earning was worth 130,000. So if we take the difference of these two, this will be the post retained earning. 174,400 retained earning is today. And when we acquired S company, it had a retained earning of 130,000. So whatever we earned after 130,000 till 174,400, that is all post. So 174,400 minus 130,000 is 44,400, and NCI was 20%. So you take 20% of this, and that will be 8880. Furthermore, remember that you also, since it was full goodwill method, any impairment that occurred, you need to give NCI the portion of it as well. So the impairment was 2,000 and you multiply it by 20%. So 400 impairment as well. So NCI at the disposal date would be 46,000 and this would be 54480. And please, while you are watching this video, just make sure that you work on the workings yourselves as well, because often when I'm solving by myself, I do some transposition errors, and people go like, how can you do that? Just check out for any numerical mistakes on your own. Yeah. So NCI at the disposal date is 54480. And now you take the net of these will be 204,400 plus 84,000 minus 54480. This is 233,920. And when you compare your sales proceeds with the net assets you're foregoing, I guess you get a profit on disposal of Leo as 66080. This is the profit on disposal. Yeah, this is the profit on disposal. Make sense? Now, as we move on, but even before we move on, let us just do one working more, because that is going to be useful for you as we move forward. Remember, we figured out that Leo company, sorry, it was new company. I'm sorry, it was new company. I might have written Leo somewhere. It was new company. So as we studied in the question, new company qualified as a discontinued operation. And since new company's disposal is a discontinued operation, we need to present profit or loss of discontinued operation separately. Do you all agree? We need to present profit or loss for the year on the discontinued operation separately as compared to our other consolidation of continuing operations. So I'll be preparing one working more before I ultimately move on to consolidation. And that is working number 2 maybe. And that is for post-tax profit or loss for the year on new. Yeah. So you need to have post-tax profit or loss on new for the year. If we first talk about the PAT, you go up, you see that new company in the total year earned 57,200. So if we talk about the post-tax profit from operations, that would be 57,200, but multiplied by 6 by 12, the normal operational income would be 28,600 for the company, right? Plus, there was a profit on disposal as well, and this you need to account it for as well. The profit on disposal, as we did it, it was 66080. So the total gain or loss that arose for the group during the year in against disposal of new company, the total would be 66080 plus 28,600. This would be a total of 94860. Now, this is what you have to show under the heading of discontinued operations. Now, sir, how do we consolidate? How do we consolidate? I'll just let you know how to consolidate. Just give me a moment. Now, how do you actually prepare a consolidated P&L? I'll show you how to prepare a consolidated P&L when there is a discontinued operation. First of all, you put up a heading, consolidated P&L for the year ending 31st December 20x3. Yeah. Then what you do, first of all, you prepare a heading and you write continuing or continued operations. And when you are preparing a consolidated P&L for continuing operations, you only consider those operations which are going to be continued. That is this parent company and this subsidiary. So you take 2Z company and Lao company only, because these are going to be continued next year as well. Whereas new company is a discontinued operation and it will not be continued next year. So how do you prepare a continuing operation consolidated P&L? You simply consolidate as if you own everything. So revenue, cost of sales, gross profit, yeah, admin expenses, then you get your PBT, then you get your income taxes, and then you get PAT from continued operations. Yeah. So how do you do this? I mean, just take the sum of these two. Very simple. Yeah. So your revenue, if I were to consolidate everything, 500, 200 plus 180, 900, that would equal to 681, 100. Cost of sales, this would equate to 249,000 plus 89, 600. This will equal to 338, 600. Then you will get a gross profit of 681, 100 minus this. I hope you get a gross profit of 342, 500. Mind any numerical mistakes that I make, okay? I'm just doing it on my own. So don't rely on me when it comes to using a calculator. So admin expenses come as 151,900 and you will get a PBT of, I guess, 190,600. Then income tax expenses of, I guess, 30,200. So I think your normal profit from continuing operations would be 160,400. And now once you have prepared a normal consolidated P&L, as you would normally do while solving any consolidated P&L question, then you will make a heading of discontinued operation. Yeah. Then you will write post tax profit on discontinued operation. You can write the whole thing down. And that post-tax profit on discontinued operation was 94860. So I write it here, 94860. So you get a total group profit. You get a total group profit after tax of, I guess, 255,260. Yeah. So on the face of the financial statements, you do not need to provide a separate discontinued operation statement. It's not a requirement. I mean, you can. IFRS 5 allows for it. But on the face of the financial statements, you are going to segregate your continuing operation and discontinued operation separately. And a post-tax gain or loss on the discontinued operation would be shown as a single line item on the face of your consolidated SOFP. And things you obviously know that things don't end here. Then you will be making one headings of profits attributable to. Yeah. So one profits will be attributable to owners of parent company. Now, when you write this area, owners of parent company will be earning something from continued operations, as well as they will be earning something which is from discontinued operations. So you need to be very specific where they are earning from, right? And then there will be something for the non-controlling parties, non-controlling interest. And here also you need to bifurcate between continued operations. You need to write it fully when you are in an exam, and discontinued operations, right? So when you talk about continuing operations first, the profit after tax from continued operations were 160,400. And technically speaking, this 160,400, we arrived at this 160,400 while we were only consolidating parent company and S1. Now remember, S1 was fully owned by us. We had 100% holding in that company. So technically speaking, continuing operations does not have any non-controlling parties. So anything that you have earned from continuing operations, nothing belongs to NCI, and everything that you have earned belongs to the owners of parent company. So 160,400 is completely written for owners of parent company. But when you talk about discontinued operation, in discontinued operation, you are talking about neo company, right? And when you are talking about neo company, you only had 80% holding of this company. So something will obviously be shared with the NCI party as well. Now, the total earnings from a discontinued operation was 94,860. And being more specific, if you figure out the breakup of this 94,860, then there were some earnings which were the profit earned during the year by the subsidiary company. And then there was some profit on disposal. Remember, this disposal has been made by parent company of its entire shareholding of 80%. So this profit on disposal only relates to parent company because they have sold their shareholding. Only from this 28,600, NCI will get something of 20%. This profit only relates to the disposal of holding of parent company, and therefore all this profit on disposal goes to parent company. So how do you do this? You go to NCI, they will get a 20% share from 28,600, which is let me just calculate it for you. 28,600 into 20%. This is 5720. Rest of all of this 94860, I mean 94860 minus 5720, which was distributed to NCI. All of this income relates to the owners of parent company, which is 89140. And this is how you balance the total of 255,260. I mean, you can provide subtotals as well, but for owners of parent company and NCI separately, but this is the total. All right. So I hope that you understand that how you will need to deal with a discontinued operation if it comes part of your consolidation question. You need to segregate the discontinued entity altogether, only present its post-tax profit or loss as a separate line item on the face of your P&L and nothing else. And this is how you work out it. I hope you read this technical article which has been given by your examiner once by yourself as well, and let me know if there are any queries in your mind. All right. So take care. It's all from my side. Allah Hafiz.